What up, fam? It's been a minute, but I'm back now, and it really seems like the 2 weeks that I decided to take off were the most eventful ones that we've seen in the market since the first quarter of this year. Now, I promised that the next one would be about Celltrion, and that one's in the lab right now, but I'm making a judgment call because I think there are some more pressing matters at hand. You're watching Sekider, and this is what's happening in our market at the end of August of 2021. Now, before we continue, I just want to remind you that this channel is meant for general education purposes only and isn't meant to replace the legal or financial advice from a paid professional. No mention of any stock on this channel should be taken as a basis for investment, since we can't know whether or not a stock is right for you. As always, we encourage you to expand your education about our market and personal finance in general beyond the boundaries of our channel. In any case, we would love it if you could like this video and subscribe to the channel, and stick with us as we explore ways to figure out whether or not a given asset is right for your portfolio. Now, everyone who's been with us for time, please do us a favor, drop a line in the comment section if you got anything you want us to touch on, but in the meantime, let's get to it. Alright, so if you've been paying attention to the movement of our local stock markets, you'll have noticed what has been a steady and steep drop off from the beginning of the month. While there are a number of non-finance based macro factors that can easily be identified as being fundamental drivers of this drop, such as the surging Delta variants, the return of lockdown measures, and the prolonged vaccine availability crisis internationally, there are a couple of specific indicators that I'd like to point to that have directly affected the equity markets here in the Republic of Korea in recent weeks. Specifically, I'm talking about the massive sell-off by foreign investors driven by rumors of an early Fed tapering, and the fall in the price of memory-based semiconductors. These are some pretty big concepts, but I do want to save some of y'all's time, so let's start with the first one, the US Fed signaling of tapering to come earlier than expected. In addressing this development, we're going to have to ask the foundational question, what does this even mean? Well, in finance, tapering refers to the progressive slowdown of asset acquisition by central banks, in this case the US Fed, and it's something that usually occurs while under a qualitative easing policy. And yes, I do realize that I explained a complex concept by talking about other complex concepts, but in the most basic terms, it just means that the US Federal Reserve, or their central bank, aims to reduce their asset sheet and in essence restrict the money supply going forward. Now, the taper is something that I expect will be talked about ad nauseum for the next few weeks and deserves some explanation here, starting with the concept of QE, or quantitative easing. Now, QE is the act of a central bank printing money and using that money to purchase government bonds. The sale of these bonds allows governments to then use that money to support people, businesses, and infrastructure in times of need. Now, over the course of the pandemic, the US Fed Chair Jerome Powell, aka J-Pow, has set the money printer to burr, filling government coffers to just short of almost $4 trillion, which the previous administration used on the two CARE Acts, and the Biden administration has used on the ARP bill signed in March of this year. These stimulus packages have helped support the economic health of the United States of America during the course of the pandemic. But traditional economics suggests that we can't be printing money forever, otherwise it'll lead to inflation. So it's up to the Fed to pump the brakes on the monetary supply line and protect the economy from the threat of hyperinflation. This is effectively what a taper aims to do. By progressively reducing the rate at which they produce government bonds, the overall capital supply to the government, and therefore the people and businesses that they support, will be reduced over time, and eventually, once the Fed pumps the brakes completely, they would simply just be sitting on the assets that they already own, allowing them to mature and letting the existing monetary supply do its thing. Now, why does this tend to spook the market so hard? Well, when the Fed operates under a policy of QE, they buy up existing bonds, and naturally this means that the bond yields drop as the bond prices rise, greatly reducing the value of long-term interest rates. That helps lower interest rates, making loans more greatly available to borrowers, both private and public. Now, this in turn lets companies undertake new projects and hire new people who go forth and increase their spending, effectively leading to more growth. A bullish real-world economy over the pandemic led to a bullish stock market. Now, tapering generally does the opposite. A progressively restrained money supply means that credit and therefore access to money gets more expensive over time, which in turn leads to less spending by both private and public entities, all in the interest of taming the beast that is inflation. This reduced access to money also means a less rosy growth picture for companies, making their stocks relatively less valuable, especially with bond prices dropping and yields increasing. Now, in recent weeks, Retail and institutional investors have gotten the impression from the Fed that they would start tapering sooner than expected, and that has led to a drop in confidence in financial markets since much of the bull run has been supported by the injection of money provided by the Fed. Also, the coronavirus is still raging without an end in sight, so there's no telling how much more money people will actually need to get through it. In any case, for many, it seems like the news of the taper is a suggestion that we're sitting at market top, which is a notion supported by historical highs in valuations. And that was a lot, but that's about it. Now for those of us in Korea in our position, the big question is actually, what does that got to do with us? Well, for one thing, we already know that retail investors don't make up the bulk of money going in and out of the stock market. A large percentage of market participants in Korea are foreign institutions who've net sold out of our market for 10 consecutive trading sessions for a total of roughly 6.5 trillion won over the first 3 weeks of August. In addition, local institutions offloaded about 63 billion won in the third trading week of this month, while retail has made up the bulk of buyers. Hopefully that's not a sign of anything bad, but there's no way for us to know for sure right now. Still, after the long bull run with new investors coming in, I suspect that we could be in for some intense volatility in the near future, and my old friend the KOSPI seems to agree with me. Now in short, rumors of the US Fed taper are causing foreigners and institutions to get a lot more conservative with their money, with the former selling off shares not only in Korea but in emerging markets across Asia as well. Now what should we do in our position? Well, I know what I'm gonna do. I'm gonna reevaluate and rebalance the risk exposure of my picks and keep on keeping on with my indexing. Remember, this is not financial advice. Alright, now the second thing that I want to talk about that is of also great importance and has led to a big drop off in shares in our market is the projected reduction in DRAM semiconductor pricing. Over the course of the pandemic, dynamic random access memory semiconductors, or DRAM for short, have seen a massive boost in sales as demand has continually surpassed supply over that time. This has been great news for Samsung Electronics and SK Hynix, who'd been sitting as the two largest firms in the country by market cap for quite some time. In fact, their first and second quarter earnings reports have been nothing but encouraging as their profits have continued to grow, with both firms beating their 2020 Q4 results for each of the first 2 quarters of this year. As with all market cycles, however, it seems as if the boom is starting to peter out, with price increases in the global memory chip sector slowing down for the first time in a long time. Now let me be clear, this doesn't mean that semiconductors are getting cheaper, it's just that the rate at which their prices are growing is slowing down. This is a fact that has led Morgan Stanley to adjust their rating for SK Hynix and has led to a near 17% drop-off in price since the start of the sell-off on August 4th. Similarly, Samsung has dropped a near 13% from its high at the start of the sell-off over that same time. Now, this might seem like small sector-contained news for a market containing thousands of firms, but we have to remember how popular index funds and index ETFs have become, and in turn how much sway both Samsung and SK Hynix have over the performance of those funds, as well as mutual funds on top of that. With reference to the latter, we could actually be seeing a lot of rebalancing in the portfolios of fund managers, according to what seems to be an industry consensus of the late cycle status of the global memory chip industry. Now, our market is going through its first big adjustment since the second quarter of this year, and situations like this may seem scary, especially for beginner investors who may have just started in the market during the highs of April through June. This is why it's important to know what you own, know why you own it, and exactly how it is that the businesses that you own run their businesses. Prices will rise and fall, but such things tend to be driven by emotion, and the negative market sentiment generated by Fed taper rumors in conjunction with the negative outlook on the DRAM market's near future are adversely affecting our market at the moment. Thus, we must always remember the old adage, price is what you pay, value is what you get. In this exact instance, with such a quick sell-off, it may be a good time to dig into reports and decide for yourself whether or not prices and value are aligned or misaligned. Alright, that's it from me. I'm gonna drop a thing about Celltrion in the next week, so stay up. Getting back on the horse in full time from here on out, so everybody new, we're happy to have you with us, and for everyone who's been here for time, you already know how much we love you. Alright, take it easy fam. Get your shots, cover your mouths, and be easy. Peace.